All right, welcome back to The Explainer. Today, we are going to put a modern, cash-burning biopharma company through the absolute ultimate investment gauntlet. As an analyst, I love testing the boundaries of classical finance. So we're going to see exactly what happens when the old-school rules of legendary value investing collide head-on with the high-stakes, volatile reality of modern medicine.
So here is the big question we're tackling today. Can the rigid, textbook frameworks of legendary value investors actually price a speculative biotech firm like AGIO Pharmaceuticals? You know, biotech is notoriously famous for burning mountains of cash before ever seeing a dime of profit. And that completely flies in the face of traditional value investing. To figure this out, we are forcing Agios's raw financial data through 4 completely unforgiving valuation lenses: Warren Buffett, Peter Lynch, Benjamin Graham, and finally, a modern discounted cash flow model. Let's extract the data, lay out our assumptions, and see if classical fundamentals can hold their own against modern biotech realities.
All right, part 1. Let's get our baseline snapshot of the company and look at it straight through the Warren Buffett lens. Here is our target, AGIOS Pharmaceuticals, ticker AGIO. Right now, it's trading around $28 a share, which puts its market cap roughly between $1.6 and $1.7 billion. Now, here's where it gets interesting. They just posted massive 137% year-over-year revenue growth, hitting over $20 million in Q1 2026, mostly driven by their thalassemia drug launch. But, and this is a huge but, they are operated with deeply negative earnings. We're talking an EPS of minus $1.69.
Okay, so applying Buffett's famous checklist, we actually get a pretty mixed bag. Agios definitely has an economic moat. They've got orphan drug designations and solid patents, and debt, totally manageable. They only have about $40 million in debt compared to a literal mountain of cash, $1 billion. But then we hit a brick wall. It spectacularly fails Buffett's earnings consistency and owner earnings tests. I mean, they posted a net loss of over $99 million just this quarter alone. They are burning cash like crazy.
And that negative 34% number perfectly illustrates why the Oracle of Omaha would take a hard pass. A negative return on equity of 34.11%, driven by a mind-bogglingly negative net margin of almost 640%. For Warren Buffett, who absolutely relies on high ROE and positive owner earnings to build his margin of safety, this stock is, well, it's pretty much uninvestable. You see, Buffett demands positive cash flow today, but Agios is actively burning its resources to fund clinical trials. In just the first quarter, R&D expenses ate up over $81 million. They're aggressively pouring money into their sickle cell disease pipeline. So for a pure value guy like Buffett, buying a stock where near-term owner earnings are intentionally destroyed for some future clinical upside, yeah, that's just a non-starter. Let's move on to section 2 and view this through the slightly more adaptable Peter Lynch lens. Now, Lynch loved what he called an asset play. And when we stack Agios's $1.63 billion market cap up against its massive $1 billion cash war chest and its $1.1 billion in total equity, well, a wild picture emerges. You can see the stock is backed almost entirely by hard assets. Honestly, it's like you're only paying about $600 million for the actual underlying business and the entire clinical pipeline. Let's run down the rest of the Lynch scorecard. Sure, his famous PEG ratio mathematically breaks down here because of the negative PE, but the rest of the board, it lights up bright green. The balance sheet is exceptionally strong. Insiders own a solid 5.4%, and yes, there were some recent insider sales, but those were prearranged specifically to cover tax bills. And check this out, institutions are buying heavily. Seven Fleet Capital Management actually bumped up their holdings by 560%. Because of this tremendous asset floor, Lynch would very likely tag Agios as a speculative buy, or at least a hold.
All right, section 3, it's time for the strictest test of all, the Benjamin Graham defensive investor lens.
Graham's checklist is notoriously rigid, but surprisingly, Agios scores some early points. It passes the adequate size test with that $1.6 billion market cap, and it easily clears the strong financial condition test thanks to that fortress of cash. But then, it immediately fails the rest. Complete lack of earnings stability, absolutely zero dividend record, and a negative PE ratio. Pass, pass, fail, fail, fail. But the real test is trying to actually price the stock using Graham's famous intrinsic value formula. Normally, to find a safe entry price, Graham multiplies a baseline PE of 22.5 by the earnings per share and the book value per share, and then he takes the square root of the whole thing.
It's a classic formula for finding value. But here's where those old-school rules literally shatter against modern biotech. Because Agios has a negative EPS of minus $1.69, that multiplication gives you a negative number. And unless you're dealing in imaginary numbers, you mathematically cannot take the square root of a negative. Graham's formula straight up breaks. It values the stock at exactly 0. To Graham, if a company is losing money, it has 0 intrinsic value, period.
Okay, Section 4. Since classical formulas are literally breaking down, let's switch gears to a modern DCF valuation model. To do a discounted cash flow on a pre-profit company burning this much cash, we have to make some pretty explicit assumptions to bridge the gap to actual profitability. First, we assume their upcoming Q2 2026 submission for their sickle cell drug gets FDA approval. Second, once approved, R&D spending drops, pushing them into positive free cash flow by 2029. Third, we have to use a very high discount rate, or WACC, around 12 to 15%, just to account for all the massive clinical risks. And finally, we'll assume a conservative terminal growth rate of 2%.
When we run those assumptions through a sensitivity matrix, we see something truly fascinating. Depending entirely on your risk tolerance, meaning which discount rate you apply, the fair value swings wildly. It goes from $21 on the pessimistic side all the way up to $37 on the optimistic end. Notice how the current price of around $28 sits almost exactly in the middle of our 13% discount model. The market is actually pricing the stock almost perfectly according to a risk-adjusted DCF.
Moving into Section 5, if a DCF requires a bit too much guesswork for you, what alternative models actually work here? First step, we can look at price to book. Agios looks surprisingly cheap here at 1.46 times its equity. You're basically paying just a 46% premium over its pure liquidation value. Now let's check enterprise value to revenue. If we take that $1.63 billion market cap and strip out the $1 billion in cash, we get an enterprise value of around $630 million. Compare that to their annualized revenues of about $83 million, and it's trading at roughly an 8.3 multiple. Now, an 8.3 times revenue multiple is not exactly cheap, so why are investors willing to pay it? Well, that premium hinges entirely on the upcoming catalysts shown right here. Agios is banking hard on their upcoming FDA accelerated approval submission for sickle cell disease. The phase 3 trial data showed some really strong anti-hemolytic profiles, meaning the drug literally stops the destruction of red blood cells. Investors are paying that 8.3x multiple today strictly for the promise of a massive revenue explosion tomorrow.
Finally, Section 6. Let's synthesize all these wildly different perspectives and get to a recommendation.
Looking at our summary scorecard, we've got a massive clash of paradigms here. The strict value gurus Buffett and Graham, they outright reject it. To them, no current earnings equals a hard pass or sell. But Peter Lynch? He sees a deeply compelling underlying asset play backed by a ton of cash. And our modern metrics, like the DCF and EV to revenue models, they suggest the stock is a solid hold. It seems fairly valued right now when you factor in the immense risks involved. Ultimately, as an analyst, your investment thesis comes down to weighing these exact factors. On one side of the scale, you have a literal billion-dollar war chest and triple-digit revenue growth. On the other side, you've got a terrifying cash burn rate with minus 639% net margins. And crucially, while that new drug is incredibly promising, the phase 3 trial actually missed statistical significance on overall pain crises, even though a subset of patients saw great benefits. It is a massive regulatory tightrope. So I want to leave you with this final thought. When you're evaluating modern, high-growth medicine that could literally change patients' lives, is that potential clinical upside worth throwing out the textbook rules of legendary value gurus? Or are Graham and Buffett right that a dollar today is the only thing that truly matters? Thanks for tuning in to The Explainer. Keep learning, keep analyzing, and I will catch you next time.